Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide. That was for chapter 7, the assigned problems for group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still do not understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so we are working on 55 here. All right, so this is our focus on decision making, our ratios, quick ratio, current ratio, accounts receivable turnover, and receivable collection period. Right. So it says here the comparative financial statements for Lakeland restaurants for 2014, 2013, and 2012 are included in the selected data. And there's the data. Right. Compute these ratios for 2014 and 2013. So these are the four ratios. Right. And then it says here, write a memo explaining to the company owner which ratios improved from 2013 to 2014, which ratios deteriorated, and which items in the financial statements changed and caused changes in some ratios. Discuss whether this change conveys a favorable or unfavorable impression about the company. All right, so I'm going to work on this part of the slide here. And I'll do each ratio, 2014, 2013, but I'm going to end up erasing them. So pause and write them down. Write down what I'm doing where you need to, because I'm going to be doing a lot of erasing here. All right, so our first ratio here that we have to deal with is quick ratio. So if you recall, the quick ratio is your most liquid current assets, which are cash, your receivables, all right, and your marketable securities or short-term investments, as the book likes to call them. Now remember that, and this is all over current liabilities. Remember, the current ratio is your current assets over current liabilities. Don't get the two confused. The quick ratio is a subset of the current ratio because even though they're using both the current liabilities and the denominator, the assets are different. The quick ratio is a subset of the current assets. So you can't just look at, for the line item here, total current assets and think, oh, okay, that's what I'm using for my quick ratio. That's wrong. All right, that's for your current ratio. It's not for your quick ratio. You have to go back and distinguish which accounts you need to use for the quick ratio. All right, so in this case here, in 2013, so I'm going to put 2013 here, and I'm going to make this 2014. And so we're going to go quick ratio here. Let me just, all right, so the math. For 2013, all right, we need our cash, which is 106, plus our short-term investments, 120, and then our net current accounts receivable. In this case here, receivables net of allowance for uncollectible accounts of 6, 6, and 5 respectively. All right, so that is 290, and that's over our current liabilities of 675. Right? So 675. All right, so that's 106 plus 120 plus 120 plus 290 is 516 over 675, and that divided by 675 gives us 0.76. So that's 0.76. Okay, so that's our current ratio for, our quick ratio for 2013. Now for 2014, we're basically doing the same thing. Right? I mean, most of this exercise is just going to be, repetitive math. What's important is to know what we're talking about when we're dealing with the ratio. So I'll explain the ratios and just do the math really quick. All right, so for 2014, I'm looking at 190 plus 118 plus 250, and that's over 650. And when I add all of that up, I end up and divide by 650, I end up with 0.86 as my quick ratio. Okay. Now, for the current ratio, and remember, current ratio is current assets over current liabilities, right? And I made that distinction here because we're dealing with both. We're going to take our total current assets for 2013, which is 1,006, and we're going to divide it by the 675. And that's going to give me 1.49. Okay. And for 2014, we have 1,023 over 650, which gives me 1.57. Okay. Next. Okay, so our accounts receivable turnover is next. Accounts receivable turnover. Okay, the accounts receivable turnover, if you'll recall, is our net sales over our average net accounts receivable, right? And go back to the theory videos for the focus on decision making, as I had a long discussion about, especially about this accounts receivable turnover. And remember, if you watch that video, the theory video, you'll recall that in order to be able to try to remember a lot of this stuff, for lack of a better word, I call it a mnemonic. I pay attention to the words that I'm using here. Notice I have the word net sales. Okay, so I can't just look at my income statement and go, okay, where's my revenue? Okay, I need to know what my net sales are. And it's the same thing with my average net accounts receivable. Okay, I can't just look and say, okay, what's my accounts receivable? No, I have to see what my net accounts receivable is, and I have to take an average. And to take an average is the beginning plus the ending divided by 2. So I'm having a beginning net accounts receivable plus an ending net accounts receivable. Add them together and I divide by 2 in order to be able to get the denominator. So, this here, even though the accounts receivable turnover on the surface, it's very easy to make a mistake if you're not thinking about what is in the numerator and what's in the denominator, and not thinking about what each and every word means. So it's very, very easy to make a mistake. But if you do understand what each word means, then all it is, the concept is really generally simple, okay? It's just a lot more additional math. It just popped into my head. And I know, for those who know or like poker, if you took somebody who is just starting out in poker, and you explain to them what a royal straight GHT flush is, okay, you know, it's very easy to say, okay, it's ace, king, queen, jack, 10, all of the same suit, okay, and explain it to them like that. But if you go and you sit and you explain the word royal to them, meaning Broadway, and if you explain the word straight, meaning 5 numerically in a row, and if you explain the word flush, all being the same suit, let's call them diamonds, okay, then they have a deeper understanding of what a royal straight flush is. But by explaining each and every word, you've taught them what a straight is, and you've also taught them what a flush is, okay, as far as their hand rankings is concerned. So this is the same thing with doing this accounts receivable turnover. If you understand each and every individual word and where things come from, everything fits together a little bit easier. All right. So with that said, for 2013, we look at we need our net sales revenue. In this case here, we only have a sales revenue account. We don't have less sales discounts or less sales returns and allowances in order to calculate a net. But all we need then is this 5,050 right here. And our average accounts receivable is going to be, let me see here. Our average net accounts receivable is going to be, right, we need our beginning accounts receivable, which is this 300 from 2012. Okay. Remember, the end of 2012 is the beginning number for 2013, right? And this the wrong number. Picked the wrong numbers. 310, sorry. This 310 is the ending for 2012, which is the beginning for 2013. And the ending of 2013, which is this 290, is also the beginning of 2014. So we take the 310 plus the 290, and we have to divide it by 2. Remember, beginning plus end divided by 2, right? And so when we're doing that math, we end up with 50/50 over 600 divided by 2, which is equal to, let me erase that line, make it a little bit easier. Right, there we go. And I'm just cleaning this stuff up here. I know my handwriting gets sloppy. So I have 50/50 divided by 600 divided by 2 is 300. And that gives me 16.83 for the accounts receivable turnover for 2013. Okay. All right. So for 2014, we're going to do the same thing. We're going to have our net sales revenue, or in this case here, just our sales revenue of 5,184. And we're going to divide that by our beginning accounts receivable, which in this case here, remember, you can't just look under 2014 and say 250. No, that's the ending. You look at the ending of 2013, which is 290. That becomes the beginning of 2014, plus the 250, which is the ending of 2014, and you divide that by 2. So it's 5184 over, let's see, 290 plus 250 is 540. Over 2, which is 5184 over 270. 5184 over 270 is 5184 over 270, which is 5184 over 270. 5184 over 270 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 is 5184 over 270. 5184 And when we divide 5184 divided by 270, we get 1920, right? So that's our accounts receivable turnover. And then lastly here we have our receivable collection period. Oops, receivable collection. Okay, so our receivable collection period is our average accounts receivable over the sales divided by 365. Okay, so our average accounts receivable, or average net, I should have wrote net in there, net accounts receivable. And this here, of course, is our net sales. But since we're only dealing with sales revenue, we just have to average out our receivable. We don't have to calculate our net because we're not dealing with an allowance for uncollectible account. Right, so our average net receivable for 2013 again is this ending of 310 plus the 290, right? Oops. Plus 290 over 2. Okay, that's in our numerator, right? Because that's the average. And then for our net sales, we have the 5,050, and we're dividing that by 365. Okay, so we have 600 over 2, and we have 550 over 365. So that's 300 over the 13.84. So if we take 300 and divide it by 13.84, we end up with 21.676, or we're going to round it to 21.68. Okay, so that's all of that math for 2013, and we're doing the same thing for 2014. We're going to take our accounts receivable of 290 plus 250 over 2 in order to get the average, and then we're taking our $51.84 over 365. Okay. Now, a thought just occurred to me. In the textbook, a lot of students, when they looked at the ratios, and notice that I used the parentheses here in order to determine, what quantities I'm working with as far as an equation. If you go and you write something like this, 290 plus 250 over 2 over 5184 over 365. Okay, some students have especially if this divisor looks sort of like this, it's very difficult to understand, what is supposed to be divided by what, especially if all of those divisor lines are all the same size. So don't write just all of the divisors. Put the parentheses around what it is that you need to be dividing so that you can make the determination as to what's in the numerator and denominator. Call that picky, but it helps clarify in your mind what you need to do, and you're going to make less of an error. So if you have an equation in the numerator, put parentheses around it to quantify it, and the same thing in the denominator. So now that I know that this is what I need to do for the numerator, this is what I need to do for the denominator, and that's my divisor line right there, okay? It just makes mentally knowing what you need to do for math so much easier. Students say, math is difficult for me, all right? Not really. It isn't. It's just not paying. Oftentimes they're not paying enough attention to basics and fundamentals, and putting the parentheses in is a basic fundamental thing that helps clarify in your mind. If you're not understanding those fundamentals, then yeah, it is confusing. Okay, I mean, it's sort of like John Wooden, the basketball coach, right? He took over the team and he just said, no, we're going to work on fundamentals. And he had his players shoot free throws to no end, okay? Because free throws make up a big part of the game. And they became so good at free throws, and he drilled them on the fundamentals, that he didn't need to be messing around with the fancy play. And in poker, that's called fancy play syndrome, where a lot of people do all of these fancy plays, but if they stuck to the fundamentals, they'd make more money. But that's a whole other story. But anyway, so here's the math. So we've got 540 over 2, and that's over 5184 over 365. So 540 over 2 is 270. 5184 divided by 365 is 14.2. And then 270 divided by 14.2 gives me 1901. So our receivable collection period for 2014 is 1901. Okay, so now it says write a memo explaining to the company owner which ratios improved from 2013 to 2014, which ratios deteriorated, and which items in the financial statements changed and caused changes in some ratios. Discuss whether this change conveys a favorable or unfavorable impression of the company. Now, I'm not going to write this memo out, or I'm not going to create one, here on the screen. Okay, you have the memo in the solution manual, and obviously, for those who are business managers, you need to know what a quick ratio is, what a current ratio is, what an accounts receivable turnover, and your receivable collection period is. You need to know what these ratios are, because what's going to happen for a business manager is he's going to be presented these ratios, and you need to know what these ratios mean and what this data means. Okay, but you're not the one who's going to be creating them. Okay, the accountant is going to be the one that's creating them. It's the business managers and the marketing people who are a function of the operation of the business. You think about marketing. Think about the operation of a business. It's on the income statement, right? You have revenues over expenses, less expenses, which gives you your profit or loss, and that's what you're in business for, is to make a profit. Okay, revenues are a function of marketing, and expenses are a function of the operation of the business, or from the business management perspective. Okay, those are what is important to a marketing person or a business manager. Business managers deal with expenses, and marketing is there to create revenues, and the difference between the two is a profit or loss. The accountant, their job is to quantify, measure, and analyze all of that information. And that's why accounting is so much more difficult than these other two disciplines, because they need to know, I don't need to know how to create a billboard ad, but I do have to know, as an accountant, the effects of that billboard ad. Okay, and the same thing with business management. I don't need to know. I don't need to schedule the employees their work schedules, but I do need to know what the effects of that scheduling is, right? And so the accountant is the one who would create, these ratios and create the memorandum, right? So I'm not going to recreate the memo. I'm going to read it, right? But understand that what is presented there needs to be understood by the marketing and the business manager, because they're the ones who, that's the report card for their business. That's the report card for them. That determines whether they're doing a good job or a bad job. Okay. And if you don't understand your ratios and the effects of them, okay, the accountant does, and he's going to report that to he's going to report those effects. Basically, that's what I'm giving you a little bit of an insight. He's not going to write up a memorandum, but he's, going to sit around with the boss and he's going to be discussing this, and they're talking about you, and you're not going to even be in the room. Okay, if you're a business manager or marketing person, and they're going to be making decisions as to whether you're performing or not performing. Okay, so I just bring this up, that don't take this. I mean, even though it's only one part of one exercise in this textbook, don't take this here lightly. All right. So it says here, the quick ratio increased from 0.76 to 0.78, right? I'm 0.76 to 0.86. And the current ratio increased from 1.49 to 1.57. These increases were largely due to the significant increase in cash. This conveys a favorable impression about the company, as it indicates the company has more of an ability to pay its current liabilities as they come due, right? So, yeah, when you increase your cash in your quick ratio and your current ratio, right? Take, to understand the concept, and I'm not going to go through it, just take the current ratio, right? You have current assets over current liabilities. Well, increase your current asset from, let's say your current liability is 500. Well, go in and do one ratio where it's 500, and then do another ratio where you increase your cash, so now you have 600. Okay, right? So obviously, this is a 1.0 and this is like 1.2, right? I'm just doing the math quickly. So, you can see how the increase in the ratios themselves is favorable to your company, okay? Which means you have more assets to be able to cover your liabilities, which is something that you want to have, which is favorable as part of performance. And other investors will look and go, okay, if you need a loan or something like this, they're able to say, yeah, that, they're increasing their quick ratios and their current ratios, meaning they have more assets available to cover their liabilities, so the company is a more solid company. Right. Next is the accounts receivable turnover increased from, I'll do this in green, increased from 1683 to 1920, and the collection period decreased, that's a decrease, right, from 2168 down to 1901. Both changes are favorable and can be attributed to the decrease in accounts receivable. Again, work through the numbers, all right? Plug in the numbers, do them several different ways. Take your receivable, increase it, take your receivable and decrease it, and see what the effects are, right? You can simulate this by just playing around with the numbers, or even use the numbers that are on this table here, and then just go, okay, well, what if this receivable instead of 290 was 320? Okay, or what would happen if it was 270? So if you do this 3 different ways, you'll have a better understanding of how those formulas work and their effects. I'm not going to go through that for these two, right? But that's what you do in order to gain a better understanding of how these ratios actually work. This conveys a favorable impression about the company as it indicates that the business appears to have a better ability collecting cash from credit customers, which is true because you're taking less time here to collect your receivables, okay? Right? Than you were before. So you're being, proactive. Now, whether that's through credit policy when, you're deciding who's you're going to extend credit to, or, that might be due to your efforts, in collecting your receivables. A lot of businesses just send out an invoice and hope to have the other business, send them the, pay off their accounts receivable. And then when it's, they look at the receivables and when it's 60 days old, then they start going, okay, well, let's contact the company. Well, maybe you should be contacting the company at 30 days in order to get them to collect, or to be able to collect. So, efforts that you've made to collect your receivables can reduce your, collection time, which is a favorable thing to you. Okay. So with that said, that's the end of, and I realize that this is a long video. It said 20 to 25 minutes, but I gave you a little bit more of an understanding here, I hope, for this. And it's the last problem that we're doing for Chapter 7. Now, I know that we have the appendix, both Appendix B and Appendix 7A. We have problems to do, so we'll see you in the next videos for them. And as always, if you don't understand something, feel free to pause the video, watch it again, go back and watch the theory videos for any of the aspects you didn't understand here. And if you still don't understand, feel free to contact an instructor.